welcome to another edition of Policy Watch. This is your one-stop shop for the entire economic policy buzz in the country. This week, we focus on the deferment of the General Anti-Avoidance Rule, or GAR, the depreciating rupee against the dollar, and the dismal IIP numbers for March. My guest this week is Dr. Santosh Mehrotra, Director General of the Institute of Applied Manpower, of course, working very closely with the Planning Commission as well. Welcome back to the show, Dr. Mehrotra. It's good to have you back on the show. Let's dive into our first story right away. That, of course, is the rollback or the deferment of GAR till 2013. Now, after weeks of protest by both foreign and Indian investors, Finance Minister Pranab Mukherjee on Monday announced that the GAR will be applied from 2013-14 onwards, deferring its application by a year. Mukherjee also said the onus of proof will lie with the tax authorities, and the proposed retrospective amendment of income tax laws will not override DTAAs, or that's double taxation avoidance agreements, in other countries. To provide greater clarity and certainty in matters relating to GAR, a committee has been constituted under the chairmanship of the Director General of Income Tax to give recommendations for formulating the rules and guidelines for implementation of the GAR and to suggest safeguards so that the provisions are not applied indiscriminately. Our Bureau filed a report. Take a look.
Dubbed draconian by industry and investors alike, the controversial General Anti-Avoidance Rule, or GAR, was rolled back by the government this week. Pranab Mukherjee made the announcement in Parliament during the discussion on the Finance Bill 2012. The contentious bill has now been deferred for a year.
To provide more time to both taxpayers and tax administration to address all related issues, I propose to defer the applicability of GAR provisions by 1 year. The GAR provisions will now apply to income of financial year 2013-14 and subsequent years.
The GAR provisions will now apply to the income of financial year 2013-2014 and subsequent years. The deferment of GAR, which can deny tax benefits under a treaty if an arrangement is impermissible, will be a reprieve for foreign investors who invested in listed Indian securities through tax havens last year. In what comes as a sigh of relief for investors, the onus of proving tax avoidance will be shifted to the tax authorities, against the budget proposal to put it on the taxpayer. The government also conceded to the demand of a parliamentary standing committee to include an independent member, an officer of the level of Joint Secretary or above from the Law Ministry, in the panel to give approvals for evoking GAR. Inflows from foreign investors in Indian shares had dried up since Mukherjee announced GAR in budget on March 16th. But immediately after the rollback announcement, the market saw a brief knee-jerk recovery. Analysts believe, however, that the market recovery might just be in the short term. GAR was introduced this budget session, and following the announcement, FIIs invested just about 576.9 crore rupees in Indian shares between March 16th and May 4th. Prior to the announcement of the anti-avoidance rule, they had net shares worth 42,822 crore rupees between January 1st and March 15th. Bureau Report, Rajya Sabha TV.
There you go. If I was a pirate, I'd say, GAR, she blows. Just a few weeks ago, Dr. Mehrotra, the top story on Policy Watch was again GAR. But that time, Pranab Mukherjee had come out with a statement saying GAR will not be rolled back at any cost. Just a few weeks later, we are sitting here again. Top story GAR again, but it's been deferred until 2013-14. What do you really make of that?
Well, what I make of that is that the government really needs to take time to formulate the rules. You know, this is the first time in the history of in our financial history that this is happening. Our capital markets are still maturing, and our capital markets need to begin to look more and more mature, both in terms of the government's regulations, but also in the way the investor is treated. And this is simply an effort to actually get into the detail of the rules and avoid mistakes, because the last thing you want at this juncture, when FII inflows have actually sort of tended to come down, the last thing you want is a stop and in fact an outflow. So this is just looking at the devil is always in the detail in these things. So it's very important that they've done this.
Would you agree with some people, especially within the government, who feel that Pranab Mukherjee sort of buckled under pressure because industry was up in arms against the enforcement of GAR? Would you agree with that line of thought?
Well, I'm not so sure that I would necessarily agree with that. I think there was rethinking probably to take into account some of the industry concerns, and industry concerns do need to be taken into account, because the last thing you want is that to completely dismiss industry and FII concerns. Right. Because as I said, you know, the FIIs have been were pulling out large amounts of funds in the year 2011. Inflows have returned in the first half of this year, but they aren't at the level at which they used to be in 2010.
Not
so the
the
point
level
is
that
that
we want them to be at.
You don't want to muddy the water in a situation like this, especially when our current account deficit is running at nearly 4% of GDP.
Right. Also, Dr. Mehrotra, I want to ask you this. Once the deferment of GAR was announced, we did see a rally in the markets. They were down. We did see some positive signs there. The rupee picked up for a bit, stocks picked up for a bit, but that was very short-lived. Do you think the huge hue and cry that industry made about the enforcement of GAR, saying that it will drive away investors, capital outflow will be huge, do you think that was a little bit over the top? Do you think that sort of danger was never really there?
That's absolutely right. I think your reading of the situation is right. I agree with your reading of the situation. You know, despite the dip in the growth rate, the India story has not gone away. We are still the second fastest large growing economy in the world after China. China's growth rate is falling, and they are sort of pretty much at the end of their demographic dividend. We are only at the midpoint of our demographic dividend. Our savings and investment rates, after having fallen, they are picking up again. So, you know, the 12th plan is projecting at least 8% per annum growth rate, and perhaps we might be able to achieve 9%. So I don't think the India growth story has gone away, and the inflows will return. So yes, you're absolutely right. They did go over the top. And I mean, the industry reacts sort of momentarily on account of uncertainty, and that uncertainty has now been done away with by the finance minister.
One last question on GAR before we go. Dr. Mehrotra, Vodafone, the tax demand that the government has raised, that was one issue also. And I'm talking about Vodafone because Vodafone and GAR taken together was supposed to be, at least by the industry, two big regressive steps that they kept talking about in the papers, in edit pages, in the media all over the place, criticizing Pranab Mukherjee and his team for that. Do you think attributing capital outflows solely on, say, the enforcement of GAR or the government raising the Vodafone tax demand would be a little unfair to the government?
I agree, again, because the Vodafone tax demand is something which the government is doing the right thing on. I think there was a sleight of hand by Vodafone, and slates of hand of this kind should not be permitted. I mean, no one believes that India is a tax haven, but at the same time, India will remain a country which will continue and should continue to receive large doses of FDI. We've received a strong dose of FDI this year, and frankly, I do not believe that just because this change is coming, the retrospective tax on Vodafone is coming, there's going to be any impact on FDI at all. It might have, I mean, the accumulation of the GAR and the Vodafone result might have led to that uncertainty in the market. But the Vodafone result is the decision is an absolutely correct definition.
Right, and I think industry also must have got what they wanted. Really, GAR has been deferred till 2013. They have 1 year, and perhaps there might be some more amendments is what we hear. We'll go into a second story after the break. Don't go anywhere. Take a short breather. Come back. We'll discuss the slide of the rupee against the dollar. Keep watching Policy Watch. Welcome back. You're still watching Policy Watch. Now, the rupee witnessed one of its worst falls against the dollar in recent times and was at a new all-time closing low as global risk aversion increased on the back of fresh weakness in the fears of foreign fund outflows from the country. The rupee depreciated 68 paisa or 1.3% to close at 53.83 to a dollar, and this came even after the RBI intervened in the forex market to support the Indian currency. The Policy Watch team filed a report. Take a look.
The rupee, which has fallen 7.2 since the budget, now stands out as a weak currency when compared with its peers such as Chinese yuan, Brazilian real and South African rand. All these currencies have appreciated this year thanks to the current account surpluses and relatively steady economic fundamentals. India's current account deficit is at 4.3% of GDP, far worse than the generally acceptable levels of 3%. D. Subbarao, the Reserve Bank governor, stepped in this week to stem the fall. The central bank is believed to have been active, selling dollars in the past few sessions whenever the rupee approaches the psychologically key 54 level. The RBI asked exporters have been asked to convert 50% of their dollar holdings overseas in exchange earners foreign currency or EEFC into rupees. The RBI has also asked banks to restrict their net intraday open positions in order to further stem speculation in the markets. Traders expect this measure to have a positive effect on the rupee in the short term, but the long-term outlook remains predominantly bearish. Bureau Report, Raj Sabha TV.
There you go. Dr. Mehrotra, the rupee lost about 4.5% against the dollar this quarter itself. How much of that fall do you attribute to Standard & Poor's negative outlook on the BBB negative rating that India has and other factors? Do you think that international agencies cutting our rating or going from a stable to a negative outlook had anything to do, or how much to do with the rupee slide?
I believe that that had rather little to do with that, with this depreciation. Please appreciate that we have had an inflation rate of 9 to 10%, our domestic inflation rate for domestically produced and sold goods of 9 to 10% per annum. Compare that to, let's say, the US economy, where it's something like 2%. Now, that differential between the Indian inflation rate and the American inflation rate has to be reflected in the exchange rate between the rupee and the dollar. So we have historically had a much sort of higher inflation rate, and that is now beginning to show. It has been showing for the last at least a year. In fact, we should be surprised that it took as long as it did for the rupee to begin to depreciate. Now, it's the speed at which it has depreciated that is the source of worry. That's the only source of worry. The fact that it needs to depreciate is something that's good, because it means that, you know, importers become more conservative, they become more sort of careful about what to import and what, because we've got a sort of highly dependent, we are highly dependent on the commodity markets. We import 80% of our oil, and our exports are growing, but they need to grow faster. This is the point.
But Dr. Mehrotra, let's talk about the current account deficit for a while. People seem to think, a lot of analysts that I talk to, a lot of policymakers that I talk to, and I'm sure you'll bear me out here, that the current account deficit seems to be the biggest driver of this rupee slide that we've seen immediately after December last year. Also, it slid for quite a bit now. How much of the current account deficit being a little higher than we actually can afford it to be, do you think, is that the biggest driver of the slide of the rupee, or do you think external factors like the Eurozone impact is also responsible?
Well, I think the driver is pretty much the fact that the demand for the dollar, domestic demand for the dollar, is greater than the supply. And so that's essentially what is driving the rate where it is. I mean, which is precisely why, in some ways, frankly, I don't regard this as too bad a thing. The only reason why the RBI has intervened is because there's been fluctuation. There's been volatility in the rupee dollar exchange rate. That's what is to be avoided, because that prevents both importers as well as exporters from planning. So, I mean, our exchange rate regime is not a fixed rate regime. It's not a It's not a flexible rate regime, it's a managed float. So the RBI comes in order to prevent volatility. It doesn't try and fix the rate.
It's interesting you mentioned the RBI. I want to ask you a question on the RBI measures that they've taken to stem the fall right now. They've taken two important steps. One, of course, is they've asked exporters to convert their overseas dollar holdings, 50% of that into rupees within 2 weeks' time. How do you think exporters are going to take that news, and do you think that was the right move by Governor Subbarao?
Well, in the short run, it is a good move. It can be reversed later if the situation changes. But in the short run, it was certainly a good move. I'm not so sure that it's going to bring in suddenly a huge amount of dollars. I mean, what needs to improve is our export competitiveness, and we've got to try and sort of, improve fuel efficiency in every field, energy efficiency in every field in order to cut our imports of hydrocarbons down. So those are the sort of structural actions that have to be taken. These are short-term measures which had to be taken by the RBI in order to respond.
Fair point, sir. There's been a lot of talk about how these measures will be short-term and won't really help in the long run. I want to ask you this. Now, the last time RBI intervened, that was in December, I think, or November, December. The rupee did get yanked back. It was at a dangerous 54 level, got yanked back to 49. This time around, these measures, do they have the teeth to yank back the rupee right now? It's again hovering around that very dangerous, psychologically dangerous 54 level. Do you think it has the teeth?
Frankly, that doesn't bother me so much whether it has the teeth or not, because at this point, the depreciation is actually a good thing for the economy, because it will lead to importers to think twice. It will also give a fillip to the exporters. That's what we are looking for. Because if we want to cut the current account deficit, that's what we are looking for. So for the moment, it doesn't bother me whether it does or does not yank back the rupee to where it was.
Since you talked about the current account deficit, what options does Pranab Mukherjee really have to balance the CAD right now? It's dangerously close to that 4% level. We can't afford that. What concrete steps can the government take to actually do something about the CAD right now?
Well, you're asking a much harder question. I mean, one of the most serious problems that is that the export competitiveness of our economy is seriously impacted by the much higher competitiveness of Chinese exports. Chinese are exporting their way to glory to India, and we are simply not able to, manufacture at the level of competitiveness that, despite the fact that Chinese wage levels have actually consistently been rising, despite that fact. So our productivity levels are simply not of the kind where we are able to be where we are able to be competitive with the Chinese. Right. That's really what is the crux of the problem.
Right. One last question on this story, sir. Is the RBI simply delaying the inevitable? Do you think, like you said, it might not be such a bad thing if the rupee does slide against the dollar? Is it going to do so anyway, even if RBI has stepped in? Do you think they're just delaying the inevitable? Very briefly, if you could, sir.
Well, I don't believe that the RBI is going to intervene in such a massive way as to prevent what you call the inevitable. But, I don't think we are sort of at any risk of further depreciation happening. So I don't think there's even the possibility that the RBI might need to intervene that much.
Right. So fair point, sir. We'll take another short breather here. We'll come back with the third story on Policy Watch. Don't go anywhere. One more story coming up your way. Keep watching Policy Watch. Welcome back to Policy Watch. Now, bad news on the industrial production front. The industrial output declined for the first time in 5 months owing to a slump in capital goods. According to the data provided by the government on Friday, industrial production declined to 3.5% in the month of March as compared to 4.1% in the previous month. Our bureau filed this report.
The index of industrial production numbers for the month of March was released by the government on Friday and, in an unexpected development, fell by a sharp 3.5%. Analysts had expected the decline to be around 1.6%. This is the first fall in IIP since October 2011, when it declined 4.7%. According to the data released by the government, growth in the manufacturing sector declined by 4.4%, while the other major sector with heavy weightage in IIP calculations, mining, fell by 1.3%. Electricity grew by 2.7%. Core sector growth in the month of March was registered at 2%, a decline of 4% from the February figure of 6%.
These figures are disappointing. Though RBI's monetary policy stance has been reversed in its last policy announcement, it will take some time for interest costs to come down. The continued weak global business sentiments are also adversely impacting the Indian economy.
Yet another slowdown in the industrial growth is sure to make the chorus for a further cut in interest rates louder, even as industry clamours for a cut in key policy rates by June. The stock markets, in a knee-jerk reaction, also tanked by more than 100 points on account of the weak IIP numbers. The National Stock Exchange, or Nifty, also fell by 53.50 points. The unexpected weak numbers are all set to put the government in the spot once again as constant policy flip-flops and have resulted in the outflow of capital from the markets. The plunging rupee hasn't helped matters either. The currency fell to an intraday low of 53.61 to the dollar after news of March IIP numbers hit the bourses. Bureau Report, Rajya Sabha TV.
There you go. March IIP slumping, not very good news for industry as well. Dr. Mehrotra, did you expect such drastic numbers from the March IIP, considering we were doing pretty well just a month ago?
You know, I don't take month-by-month changes that seriously.
You sound like the finance minister.
No, it's not. No, you have to please appreciate the following fact, that there are serious problems with the IIP index itself. So can we get our statistics in order? There are issues about, we keep talking about the inflation rate. We use the wholesale price index as the measure. There are very many issues about the way the WPI is calculated. There are similar issues with the IIP. Our statistical system really needs to improve and get its act together. So that's the first important point I would make. So even journalists like you have to stop worrying about monthly changes until and unless we put our statistical system in much better condition.
A thought echoed by Mr. Rangarajan as well yesterday, saying that we need some serious rethink in how we calculate our IIPs.
Well, I'm not surprised that a man of his stature is saying that. So I'm in distinguished company in that regard.
Absolutely, absolutely.
Having said that, I mean, we all know that interest rates have been high, investments have not been as one would have expected them to be. And if output is not growing and there is a drawing down of inventories, this is what you get. I mean, so that is inevitable. One only hopes that, as your report said, that interest rates will come down, investment will begin to pick up, so the IIP numbers will begin to look better. But I would reiterate, let's not worry so much about monthly.
Fair point, fair point. Let's not worry so much about monthly numbers, but talking about the interest rates like you just did, industry of course is sure to pick up their demand and sort of hound the RBI, saying that by June, cut another key policy rate by, say, another 100 basis points. Do you see that happening at all? Do you see the RBI taking such a step?
Well, I hope it does, because clearly the finance ministry is doing its bit in order to cut the fiscal deficit down. That is the reason that the governor of the Reserve Bank has been giving for the last year or so as to why interest rates have had to be raised. Well, fiscal consolidation is on its way. So hopefully he will cut, because clearly we cannot allow the slippage in the growth story to continue any longer. We are at the beginning of the 12th five-year plan. We really need to start the first year off with a big bang.
Dr. Mehrotra, one last question on the story before we wrap up the show. Manufacturing capital goods have sort of held the flag up high in the recent past. They performed really well. This time around, capital goods was the biggest loser. Why do you think that is?
Well, it's not entirely clear to me why that might...
And manufacturing too.
Well, I think manufacturing, as I was saying to you, output is impacted partly by current investment, partly by what is happening to sort of inventory. So, you know, as I was saying, investment has not been taking place at the pace that we would desire. So all that's happening essentially is that inventories are being probably drawn down.
Right.
So that's essentially what you're beginning to see here.
That's right. Thank you, Dr. Mehrotra, for coming on Policy Watch. So that's when we end our show. That was Dr. Santosh Mehrotra, of course, coming on the show once again. Thank you so much for that. We, of course, chatted about GAR. That was our first story. What my guest seemed to think, and I seem to agree with him, is that the industry kind of overreacted on the imposition of GAR. Now it's been deferred till 2013. Industry has 1 year. There might be more amendments to GAR, but that, of course, has to be seen when 2013, that fiscal year actually starts. A sigh of relief for industry there. The second story on Policy Watch this week was the depreciation of the rupee. What we got from the discussion with Dr. Mehrotra today was, of course, that it might not be such a bad thing if the rupee is depreciating. And he also thinks it might not slide down further. It could be yanked back. RBI, of course, is doing what they can. They're doing their best. The two steps that they've taken, of course, have arrested the slide a little bit. We'll have to see, wait and watch where that goes once RBI, of course, swings into action again. They might actively start selling dollars, but that's something is just a theory right now. We have no evidence, really, that the RBI has been actively selling dollars. As for the IIP story, now, of course, Dr. Mehrotra rightly said that we have to stop worrying about monthly trends, and as Dr. Rangarajan has also suggested, so did my guest on the show today, that we have to take a serious relook, a rethink on the way we calculate our IIP numbers. That has to be taken very seriously by the Finance Ministry as well as the Department of Statistics organization of the government as well. That's all the time we have from the studio tonight. Till next time, when we get you another guest and the next three top stories of next week from and all the economic buzz, of course, on Policy Watch. This is Athar Khan saying goodbye. Thank you for watching.